welcome to IB Business HL, and we're going to talk about profitability and efficiency ratios. This could be on your upcoming topic 3 test. So profitability ratios show a company's overall efficiency and performance. They are divided into 2 types: margins and returns. Ratios that show margins represent the firm's ability to translate sales dollars into profits at various stages of measurement. These are profitability ratios per se. There are also profitability ratios that show returns, and these represent the firm's ability to measure in overall efficiency in generating returns for the shareholders. And then we're going to talk about how we calculate these profitability ratios. So profitability or performance ratios, these are indicators of the extent to which the firm's effective use of its resources enables it to create an excess of revenue. So how we do that is by calculating the gross profit margin. So gross profit margin is also known as your GPM. So here we have your gross profit margin. So basically this shows the gross profit margin as a percentage of sales revenue. It indicates the profitability of the core business activities, and it's calculated by the formula, which is the GPM is equal to the gross profit over the sales revenue. So you have the gross profit and then you would times it by 100 at the end to get a percentage. So in many of your textbooks, you would have like a profit and loss account. And the profit and loss account, you would already have your opening stock and everything for your sales revenue, and you would probably already have the gross profit. So to calculate the margin, you would just multiply that by 100, and you would get your gross profit margin. So different industries require different gross profit margins, and you always have to check the industry standard, because you never know how much your gross profit is and how good it can be compared to your industry. It varies from different industries, from the entertainment business to services and goods. It varies in many different ways. So after you do that, the gross profit margin also has an impact on the net profit. The higher the gross profit margin figure, the better for the firm. And if the figure is low, the firm must implement strategies to raise it. So there are many strategies you could have to raise gross profit margin. You could change the price, you could reduce the price by establishing economies of scale, and you could reduce the price by finding cheaper suppliers. Or a change in quantity could be done by promotion, by putting different employees and making their advertising efforts more, accumulating more of their advertising efforts. Or you could lower the cost of COGS, which would lower your sales revenue, and you would have a better gross profit margin. So the other way you have for profitability and efficiency ratios is your net profit margin. So your net profit margin is like a percentage of the sales revenue, and your net profit margin can be calculated by, that was a bad N. Okay, so your net profit margin is the net profit before the sales, interest, and tax. And then you could you divide it by the sales revenue again, and you times it by 100 as like the same thing for the gross profit margin, and you would get a percentage of your sales revenue. And this percentage, like if let's say this ended up being 31%, this would indicate that every $31 out of every $100 of sales revenue in the firm's profit after the COGS and all the expenses have been deducted. So there are also possible strategies to improve your net profit margin, which is increasing sales revenue, lowering your COGS, and reducing operating expense such as rent, electricity, or stationery. And now we have one more ratio we're going to talk about in this one, and it's the ROCE, or return on capital employed. So we're going to erase this real quick. And this one is called return on capital employed. Okay, so for the return on capital employed is like a profitability ratio that measures how efficiently a company can generate profits from its capital employed. And to figure this out, we do net profit before interest and tax over the capital employed and you times that by 100, and you end up getting your ROCE. And then this firm's resources can be summed up by the capital employed, which is calculated using the formula here, where we would have the capital employed and then you add the long-term liabilities and the share capital and the retained profit to find your capital employed, which you use over here to find your return on capital employed. And the return on capital employed will be used to calculate how the capital employed is benefiting the firm or any company you're building. And possible strategies also to improve the return on capital employed could be reducing the long-term liabilities, which would reduce the capital employed, which would help the return on capital employed. Reducing equity and retained profit would be another one we would use, and that is what all the ratios we have in 3.5.1. In this part, we're going to be looking at useful ratios called liquidity ratios. Liquidity refers to the firm's ability to convert its short-term assets into cash. These are a measure of the company's ability to settle its short-term debt obligations. So we're going to have two liquidity ratios. They are called the current ratio and the asset test ratio. So these two ratios will help us measure which degree an asset or security can be held on to by a company or quickly bought in the market and therefore converted to cash, not affecting the asset's price. So first we're going to talk about the current ratio. So this shows like a firm or a company's ability to pay off its short-term debt using its current assets. So like the sale of assets. Since there is a short time to raise the needed funds, cash and more liquid assets are used to pay off the debt. Current ratio is calculated by this following ratio. So we're going to have our current assets over our current liabilities. So we have our current assets divided by our current liabilities, and these relevant figures will show us what our current ratio is and how the sale of assets can help us pay off our debts really quickly. And then the other one we have, but before we do that, we're gonna obviously talk about possible ways to improve our current ratio. So first we have to improve the credit system that we show to other companies or other people to show how we can pay off our debts if we're using a loan. And we can use the sale of our unused assets, which are assets that the company does not use anymore, and you can sell them even though they might not be sold at the same price as before. The sale of these assets can help us with our current ratio, and especially because they are not used anymore. And the other one could be negotiate longer pay terms with our suppliers, decrease which can either affect your relationship with the supplier, so this will be a reason that's not a good choice. And the other one is monitor the owner's draw and like how much cash drain the owner is making. So this one, now we're going to do the asset test ratio, which could also be known as the quick ratio. So the quick ratio is more of an immediate or severe indicator of the firm's ability to pay off its short-term debt. It excludes the stock figure from current assets because stocks are not as liquid and depend on the state of the market. So the ratio for this would be current assets minus stock divided by our current liabilities. So we're gonna have the current liabilities. So this is a more immediate action, or how quickly a firm can pay it off, and we use this ratio to know how fast a firm would be able to pay their off, but we do not include stocks, which is kind of the downfall of this ratio, and this is why some people use a current ratio. But this ratio can also be helpful for other companies to see how quickly you would pay off their loan if you would get one from them. So there are many ways to improve this. Again, you could increase your sales, which is what a company would be trying to do, reduce your covered current liabilities, and reduce the drawings, the amount of money you take out of the company, or again, you can do the sale of unused assets.